Good morning, everyone, and welcome to the weekly Fundamental podcast. I'm Rusmik Oza from Kotak Securities. On the international front, global markets paused last week as rising yields dominated the discussions, raising some concerns to this year's rally. The US 10-year bond yields have risen from below 1% to 1.33%, building an economic impact of the US $1.9 trillion stimulus package. On the performance side, MSCI Emerging Market Index has given 7.6% return in this month to date, which is higher than the 5.4% return given by MSCI World Index. Since start of this calendar year, the MSCI Emerging Market Index has delivered 10.7% return as compared to 4.3% of MSCI World Index. Bloomberg's monthly survey of economists forecast showed that the US economy is expected to expand by 4.9% this year, the best in almost 40 years. Stronger economic recovery aided by stimulus is fueling inflation worries. Expectation of strong growth and higher bond yields is making investors shift from gold to industrial metals such as copper. Gold spot prices touched 7-month low last week, while copper rallied to almost 2011 highs. Moving over to India, the Nifty 50 and BSE Sensex declined by 1.2% last week, whereas the broader markets, that is NSE Mid Cap 100 Index and BSE Small Cap Index, both ended in the green last week. Oil and gas and power stocks were major gainers, while pharma and select consumer stocks lost the most in last week. Nifty PSU Bank Index has gained nearly 36% in this month to date, with 11% gains coming just last week. The formation of stressed ARC and privatization of two PSU banks has lifted sentiment in PSU banks. India's GDP numbers for Q3 FY21 will be published this week. Economists expect GDP projections to range between -1 and +1%. From a market perspective, Q3 GDP numbers should not matter as Q3 corporate earnings have been far better than expectations. The disconnect between GDP numbers and corporate earnings also shows there is a big shift already taking place between the unorganized players to the organized and listed players. On flows, this month to date, FIIs have bought Indian stocks worth $4 billion or around rupees 29,500 crore, which is quite healthy. Flows resumed in a big way after the union budget, which was highly growth oriented. On the other hand, DIIs have remained net sellers this month to date, with net selling of rupees 16,638 crores. Flows have been muted in most emerging markets this month to date except for India and Taiwan. On earnings, the Q3 FY21 earnings season has turned out to be very good, with more positive surprises leading to upgrades in future estimates. Q3 FY21 adjusted earnings of Nifty 50 has increased by 18.5%, with strong EBITDA growth of 19.9% year-on-year basis. Net profits of our covered universe increased by 47% YOY basis in Q3 FY21 versus initial expectations of 43%. On the revenue front, sectors like cement, consumer durables and retail beat our estimates, whereas capital goods, agrochemicals and healthcare services missed our estimates. On the earnings front, commodity chemicals, pharmaceuticals and transportation sectors beat estimates, while banks, NBFCs and real estate disappointed. We now expect earnings of Nifty 50 to grow by 20% in FY21 and 25% in FY22. This is vis-a-vis 12% expectations for FY21 and 28% expectations for FY22 at the beginning of the result season. The revised Nifty 50 EPS estimates for FY21 stands at 531, for FY22 at 673 and for FY23 at 794. Valuations of Nifty 50 is very rich at around 22.3 times on 1 year forward basis, that is FY22 estimates, but reasonable at 18.9 times on FY23 estimates, which is on a 2-year forward basis. There is very little price value disallocation in the market, with most sectors and stocks already discounting FY22 estimated earnings. We expect muted single-digit returns from market over the next few months as valuations are rich and possibly higher bond yields may offset potential earnings upgrades. Automobiles, consumer durables, IT services, and pharmaceutical stocks are trading well above pre-COVID on in terms of the forward PE multiples. Our belief in economy-driven sectors has further strengthened after the budget. Few sectors and pockets that we can visualize that can make money for investors given their past underperformance and potential recovery are banks, capital goods, construction, engineering, oil and gas, cement, real estate, and metals. We expect global bond yields to gradually move higher from now till the end of this calendar year, which could impact emerging market currencies and lead to moderation in equity valuation. Till the time it is gradual and not abrupt, markets can adjust to it. Considering the potential rise in bond yields, we are building in some kind of moderation in Indian equity valuations to take place in the second half of this calendar year. We are not extremely bearish on the market as the massive stimulus which is likely to continue in the developed markets in this calendar year and the economic recovery globally both put together should provide support to markets at lower levels. For India, most of the factors driving markets are in place except for valuations. As time goes by, India's valuations will moderate, making it a good buy on dips market going forward. From above 15,400 levels, the Nifty 50 has closed below the 15,000 mark last week. The next major support for Nifty 50 comes at 50-day moving average, which is placed at 14,230 levels. In the near term, Nifty 50 can range between 14,230 and 15,500, whereas on a wider range, for the year end, it could range between 13,000 on the lower side and 16,400 on the higher side. We note that the 1 year for Bloomberg consensus target for Nifty 50 has now moved to 16,400. We might cover more stocks and sectors in our next weekly podcast. So that's it from my side. Have a great week ahead. Thank you for listening to the podcast.